Now the first product we talked about, which we should discuss in greater detail now, is the traditional vanilla loan, simple amortizing loan. You take a loan, you repay it over a fixed term that the lender has given you. Your loan is fully therefore amortized and repaid. You take your documents and you go home. Now remember one thing, for this and all the other options that we are going to talk about, most lenders will now offer loans on a variable rate or a floating rate because of the volatility of their cost of funds. There are some institutions that might offer a fixed rate, or some which will offer a hybrid, a mix of a portion of the loan in fixed and a portion of the loan in variable. Now as a borrower, what should you do? If you have the option, should you take the fixed rate or the variable rate? Often it is difficult because that is a function of whether you can predict what is going to happen to rates going forward. If rates are going to increase, then a fixed rate loan today makes sense. If rates are going to decrease, then a variable rate makes sense. So a lot depends upon the dynamics of the economy and what the perception is. So as a lender, I will typically offer a variable rate since it protects me on the volatility on the other side of the balance sheet, my liabilities. As a borrower, the prudent thing or the safe thing or the conservative thing will you try and take a mix. But that also is not offered by everybody, and therefore you might end up taking a variable rate loan, which in the long run might not be wrong or might not be disadvantageous to you, because typically from a logistic perspective, the variable rate should be a little lower than the fixed rate at any point of time. So for example, if a fixed rate is being given today at 8%, the variable rate might be 7.5 or 7.75. Of course, you are open and vulnerable to interest rate going upwards or downwards, but typically there are floors below which it won't go, there are ceilings above which it will not go, and there are also fixed times when the lending institution will review and up the rate or down the rate. So you have some comfort built around these parameters, and therefore a variable rate might be the better option. Now, having talked about the traditional fixed EMI loan that you pay, let's talk about the two step up and step down variants that exist. And let me start this with an example. Let's say there's a young couple which is qualified, say an engineer, a doctor, a professional in some way, and they take a loan today. Their combined salary, supposing, is 1,000 rupees, purely an example. And because it's 1,000 rupees, you give them an EMI of 400 rupees, that's an FOIR of 40%. Now they start paying this, and based on that, you've given them a loan and they start paying that. Now, over the next few years, in fact, over the next several years, their income, whether they are salaried or whether they are professionals who are self-employed, is going to step up. So that 1,000 rupees that we estimated at the time of giving the loan, maybe 3 years later is going to be 2,000, and maybe another 3 years later is going to be 4,000. Now, if the EMI is kept constant, then what happens is the original FOIR, which was 40%, 400 divided by 1,000, now becomes 400 divided by 2,000, which brings it down to 20%. And then if you go to 4,000 rupees income 6 years from later, it comes down to 10%. Now, while there's nothing wrong with that, the fact is that these customers, this young couple, can service a higher loan amount with a higher EMI as the years roll by. To step up the EMI every 2 years, to recognize the income assumption that it is going to increase. This way, two things happen. The customer, the couple, can repay the loan faster, but more importantly, you can give them a larger loan, because now you're appraising them not on a 15 years 1,000 rupee income, but a 15-year 1,000 rupees this year, 2,000 rupees 3 years later, 4,000 rupees 6 years later, and so on. Obviously, they can pay more. Even if you maintain a 40% ratio, for example, as an FOIR or an IIR, at the 4,000 rupee income 6 years from now, they can pay 1,600 rupees. That's 40% of 4,000, as against the 400 rupees EMI which you gave them 6 years ago. Now, because of this, you can increase their loan eligibility and make it possible for them to buy a larger house or a house closer to the center of the city, or to build a larger house. Now, one thing you have to be careful about, and I'm not going into too much detail on this here because we cover it in our module on mathematics in housing finance, is that you should be careful that whatever EMI you set at the beginning of the repayment, which is lower because their current income is low, it has to be enough to recover the interest that is being paid or that is required to be paid. Because the last thing you want is that you don't even collect the interest for the year one, and that outstanding shortfall of interest is added to the loan amount, and therefore the loan amount, instead of decreasing as it amortizes, goes into an increasing mode. Now, unless you are able to turn that curve downwards, you are going to have a problem. The loan will never get repaid. So therefore, a negative amortization is something that people resist in their minds, because they think that after having paid so many EMIs for 2 or 3 years, how come their outstanding loan has actually increased? And therefore, fix the EMI, step it up based on some reasonable estimate of increase in income, and therefore you are able to amortize the loan and also give the couple a larger ticket loan than you could have in the traditional manner. Now, is there a risk involved with this? Of course there is. From a lender's perspective, the risk is that the income that you have assumed might not actually materialize. In order to avoid that, what you should do is you should make assumptions which are reasonable and conservative rather than aggressive. From a borrower's perspective, you should take this loan if you, as a young couple, as a young individual, as a professional, can see very clearly your income career graph increasing at a fairly steep angle. If that is so, and you have aspirations to buy, say, a 2-bedroom house instead of a 1-bedroom house, and you are reasonably confident that you will be able to service a larger loan going forward because your income has increased, you then should go for a step-up loan. Now, the third variation or offering that lending institutions offer to individuals like you and me is the flip side of the step-up, otherwise called the step-down. Now, let's take 2 examples again to illustrate what we are saying. Let's say, for example, there is a couple where the husband is retiring in 5 years and the wife still has 10 years to go. So he is 55 and therefore retires at 60, she is 50 and therefore retires at another 10 years. Now, if they came for a loan, I would now look at it logically from a lender's perspective, right? The lender would look at it and say that this couple is earning a joint income, the husband and the wife, for the next 5 years, at the end of which the husband's income is going to stop. But the wife will continue for the next 5 years also. Therefore, her servicing capacity alone is for a 10-year period. Now, either I can do one of 3 things. One, I can give them a 10-year loan, which is the retirement age of the wife, who is the younger of the two, but that won't be fair or correct both on the lender or the borrower. In 5 years from now, the income of the family is going to drop because the husband's income will stop. Let's not get into pension income because that's a different argument that comes up when you're doing appraisals. Now, because that will happen, you can't do a 10-year loan with an EMI that is recognizing the combined income of the two. Not fair on the lending institution because they are at risk at the end of 5 years. On the other side, I could do a 5-year loan and assume that when the husband retires, the loan should have been repaid, which again from a borrower's perspective is not good to do because the wife has some capacity. Let's take an example. Both husband and wife are earning 2,000 rupees each per month. Their combined income therefore is 4,000. But that's not going to continue in the 6th year and the 6th year onwards because in 5 years the husband will retire. So while today their combined income of 4,000 at a 40% IIR allows them to service comfortably an EMI of 1,600 rupees, 6 years, 7 years, 8 years, 9 years, 10 years, they at 40%, the amount they will be able to service is 800 rupees because that is 40% of income of the wife, who is now the only earning member in the family. Similarly, when I flipped it around and only gave a 5-year loan with an EMI of 1,600 rupees, I was being unfair to the servicing capacity of the family, which 6th year onwards would have at least been 800 rupees, 40% of the wife's income. So what happens typically is that lending institutions offer a step-down facility. It's a combination of both the situations we discussed. The loan goes through for 10 years because that is the term that the wife has before she retires. But the EMI does not remain constant and therefore recognizes the drop in servicing capacity at the end of the husband's job tenure. Because he has now retired, his income has stopped. So at the end of 5 years, from the 6th year onwards, there is an EMI, but there is a step down from the 40% of the combined income to 40% of only the wife's income in our example that we just did. Now when you do that, the lending institution is being prudent and is recognizing the changed circumstances post the husband's retirement, and also the borrower is getting an advantage because now they are getting a loan which actually goes through to 10 years, does not stop at 5 years just because the husband has retired, and at the same time does not stress the servicing capacity of the family post the retirement of one of the two earning members. So that is a step down facility. A typical example is what I told you, husband and wife. Husband is retiring in 5 years, wife has got longer to retire. Another example can be a parent and a child. So for example, a father and son take the loan. The son is 25 or 30 years old and therefore can take a loan for 15 years. The father is retiring in 10 years and therefore the combined income of father and son is available only for 10 years. Give them an EMI which recognizes this combined servicing capacity. At the end of 10 years, you can actually step down the EMI to only recognize the son's earning capacity and the son's servicing capacity because now the father has retired. Now as a complication, and just purely as a complication, don't try and do a step-up loan for the son and a step-down loan for the father and son and all those things, because quite honestly, given what we talked about negative amortization and all, the scope for doing a step-up is limited. You can't step up the EMI beyond a point and keep the current or the starting EMI so low that you result in not even recovering the interest, resulting in a negative amortization at least for the first few years before you step up the EMI and start recovering a larger portion of the outstanding loan amount. Again, who should take this loan from a borrower's perspective? Like I said, husband, wife, husband retiring earlier than wife, wife income continuing, father and son, parent and child. Therefore, their capacity also changing when the father retires. A step up or a step down is something that you as a lending institution should decide the target group, and you as a borrower or a borrower along with the co-applicant, maybe the wife, maybe the parent, should be able to be comfortable to service that loan. The benefit, you will get a larger loan than a very conventional loan where it goes through for the full term. In the step down case, where the loan amount is repaid within 5 years and by sheer limitation of the term, the loan that is given to you is lesser than if I step it down and still continue it for 5 years more.